There we go. Great. Well, thank you very much. First I want to start off with thanking Keiretsu. We are real estate lending fund managers. We have a fund based in Seattle that we launched roughly 4 years ago, and our relationship with the Keiretsu Forum goes back that far as well. I think this is either my third or fourth expo. I've done the road shows in the Bay Area and the Pacific Northwest, and I presented at the Mid-Atlantic Forum with Howard's group last fall. So we're very appreciative. We've raised nearly $7 million for our first fund from Keiretsu. We have approximately $60 million under management. These numbers are somewhat dated. We have closings on the first of every month, so we pretty regularly close anywhere from $2 to $3 million a month. I know I've seen a number of my investors in the audience. I think I have a half a dozen investors here as well. I also want to thank you for your continued support. Let's see here. Yeah, I have to stand closer. There we go. So our first fund based in Seattle, we launched in August of 2010. The way the fund works is we pay monthly cash distributions, and I'll tell you how that's calculated, but the net return for all of our investors since inception is about 11.5%. What I'm here today to talk about is fund number 2. Similar to fund 1, the goals of fund number 2 are to minimize risk of principal loss, first and foremost. What we've tried to take is the real estate lending model, or pejoratively the hard money lending model, and strip as much of the risk out as possible. We provide investors with a high yield debt investment, and we like to maintain near-term liquidity. Just launched fund number 2. We are focused on the Mountain West region for fund number 2. We find hard money lending very regionally focused. This fund will lend in Colorado, Utah, and southern Wyoming. A little bit of market comparison. Denver is very similar to the Seattle market. Medium incomes are quite comparable. And there's two really important things. Can we generate the return for our investors in this market? Real estate markets tend to be very regionalized. What we charge our borrowers is anywhere from 3 to 5 points up front for a 12-month loan, as well as 12.5% interest. So we're looking at real estate markets around the country where we can replicate those economics. I think probably the most critical criteria for where to open up a second fund is judicial, non-judicial foreclosure status. Some states are judicial, other states are non-judicial. Non-judicial is a 4 to 6 month process when we have to foreclose. A judicial can be 1 to 2 years. Obviously, that has a big impact on returns. This is a model where there will be defaults and foreclosures, so we have to manage that appropriately. A little bit more about the market strength. Denver's quite strong, one of 10 metropolitan areas enjoying a full rebound that everyone is reading about in the papers. I think most importantly, it's home affordability. We look at this very closely. A family with a median income in the Denver market has 170% of the income required to qualify for a home loan. As we've seen this real estate rebound, we've seen rents go up quite a bit. What we do in our first fund and what we anticipate doing in our second fund is lending a lot towards the building and construction of first-time home buyer houses. These are $200,000 to $400,000 houses where a mortgage payment is anywhere from $1,200 to $1,500 a month. It's pretty comparable to what you would rent an apartment for. Denver activity is quite robust. There's 10 million square feet of construction activity in Denver as of last fall. Very, very high occupancy rates, low vacancy rates in the market. We are building both starter homes. We also build fourplexes, duplexes, small apartment buildings. We'll also do bridge lending against commercial projects. Differentiating factors, very similar to our first fund based in Seattle. We do not use leverage at all. What we do is we lend in a first position only. We are the bank for these builders and developers. If we were to use leverage, obviously we wouldn't therefore be in the first position anymore. The other thing that we do, which is quite important, sometimes it's worth something, sometimes it's not, is require personal guarantees from all of our borrowers. Really, even if a borrower does not have a significant net worth, what that does is it's an extra hook into them to know that, look, we will come after them for whatever they have if there is a foreclosure. Underwriting process. We take our underwriting process very seriously. I think a number of investors have actually been up to our office in Seattle so they can see how we put together our loan files. But it all starts with the third-party independent appraisal report, which we then break apart. But we're building, 3-4 inch loan files, similar to any sort of, mortgage underwriting office. All of that is available for review in our office in Seattle. Loan economics. So, how do we return 11.5% to investors? Well, our borrowers, we're targeting gross yields to our borrowers of 18 to 20% a year. So they're paying in combination of origination fees and interest rates anywhere from 18 to 20%. In only one instance in our Seattle fund have we actually completed a full foreclosure process. We've had no loan losses, but in the one case where we completed a foreclosure process, we received all of our principal back. It was in default for up to a year. We received 2 points a month in penalty interest, and we are still working on getting our late fee. So if you look at our returns of December of last year for our first fund, you'll see a spike in the return. That's actually from us realizing a foreclosure process. That loan went into default. Many of our investors say, look, I make more money when you actually have a default and you foreclose. And I say, well, yes, but that's not the idea. We want to get paid back. We want a lot of repeat borrowers. We want to be lenders, not equity holders. Why does this opportunity exist? Historically, this is an opportunity that has been serviced by regional banks. As part of the real estate meltdown, credit crisis, a lot of regional banks went under. A lot of regional banks were acquired by larger banks, and frankly, they didn't have the capabilities anymore to make these loans. Think of it as there's two types of underwriting criteria generally where you can make a loan. You can make a loan based on assets. You can make a loan based on cash flow. What we're seeing right now out in the market is banks will lend on cash flow. The problem is builders and developers have lumpy cash flow. They need interest payments built in. They'll have 2 or 3 big paydays a year, and therefore they don't qualify for cheaper bank financing. An alternative to us is to get an equity partner. Equity partners are more expensive than we are. Typically they get their money back first, they get a rate of return, and then they get half of the profits. We're charging 18 to 20% on an annualized basis with no prepayment penalties. If the builder can build a house in 4 months and takes a year loan out from us, they can pay it back in 5 or 6 months and it dramatically reduce their cost of capital. Investor terms, similar to Fund 1. Fund 2 raises capital through the issuance of membership interest in an LLC. Minimum investment is about $100,000. For the Denver fund, we can accept up to $2 million per month. Our Seattle fund, we've accepted up to $5-6 million a month. And that gets to not using leverage. We have to make sure we have the loans before we bring in the capital. Otherwise, we're sitting on cash, and that dilutes everyone's returns. Most importantly, monthly cash distributions. Investors love that. I send investors a check or an ACH every single month, and we only ask for a year lockup. Reporting and auditing, our Fund 2 will be valued and reported on monthly. That goes with the monthly distribution. All sales are through our affiliated broker-dealer. And Fund 2 is not yet audited. Fund 1 has been audited every single year. The audits are available for review for anyone that has any interest. I'd like to wrap up saying, again, thank you for the support from Keiretsu. I have copies of the presentation back at my booth. And that's it.
Great, Adam.
Thank you.
Okay, right, so the redemption is 1 year. So if I put my capital in today, then I can't get it out for 1 year. Is that what you're saying?
Yes, 1 year, and then redemption's quarterly.
Quarterly. Okay, I think that's important because, quote unquote, run on the bank. You don't want to run on the bank. You want it to be orderly. And obviously, you're making good loans. Let's talk about issues with any of your portfolio. What are you? You probably are expert in NODs and notice of defaults and going through that foreclosure process. What are you, 1 or 2% of your portfolio?
Less than that. I mean, we've had one default that completed the foreclosure process. We have one default right now in our first fund. That's it.
Okay. Question back there. Okay, please.
Good morning. A quick question actually 3 quick questions on the borrower side.
Okay. How about 3 long questions?
Loan to cost that you're typically doing on your deals, average loan size, and what's the typical project look like?
So for the first fund, for both funds, LTV, loan to value, is 65% or less on each loan. Our portfolio LTV ratio is about 58, 59%. Average loan size has increased over time as the fund gets bigger. We're probably anywhere from $1 to $2 million in our first fund. Obviously, the Denver fund will start smaller. We have a cap of, I think it's $1 million or 10% of AUM for Denver. And I forgot the third question.
Yeah, I've lost money.
Typical project.
Typical project, we do a lot of starter homes, duplexes, about half construction loans, half flip loans.
Okay. I said I've lost money in everything, and I also made money in a lot of things. So how are we going to lose money, if at all?
How are you going to lose money? That's a good question. Obviously, there could be another black swan event. The market could go down 40 to 50%. I don't think that's going to happen. If the market goes down 40 to 50%, then we'll be about par on the portfolio. Okay,
so your LTV, your loan to value ratio right now on investment, are you 65 or 75% LTV?
65 is max. Our portfolio is about 58.
58, and so right now, where is your mostly West Coast?
Our first fund lends in Washington, Oregon, and Idaho. The Denver fund will be Colorado, Utah, and southern Wyoming.
So you're closing out a fund today, and then obviously you're talking about what's next.
Yeah, we're actually not closing out the first fund. We still accept investors in the first fund. We anticipate taking that to about $100 million. But the Denver fund, we're just launching, and the first target there is $50 million. Okay,
and so typically when somebody comes in, it's important to come in a little slow, and you see most of your investors re-upping?
Yeah, most of our investors re-up. I've probably only had 3 or 4 redemptions for various personal reasons out of 170 investors.
Okay. And then also we have a disclosure issue always at Keiretsu Forum. If you're an investor, let us know. And the next question, you're an investor. Happy investor?
Happy investor.
Okay, yeah.
Okay,
please,
very pleased. Adam Edlichtig, how are you?
Great. Nice to see you again.
How many of the people, nice to see you too. How many people from the wait list on your current Seattle fund are transferring to the Denver fund?
It's actually interesting. It was hard to raise money for the first fund. When we announced the Denver fund, we're doing our first loan this week. People started sending in paperwork and checks. So we're sitting on $2+ million for the Denver fund, just waiting to close. We have to line up the loans, obviously. But a lot of the investors from the Seattle fund are investing in the Denver fund.
So is there a wait list for the Seattle fund any longer?
There's still a wait list for the Seattle fund. It's about a month or 2 long.
Did I get it, Ed? Okay. Wonderful Keiretsu Forum member last 12 years. Also, we're going to be announcing Keiretsu Connect a little hour from now. Bob.
How do you source your deals, the loans themselves?
Sure. It's a combination of real estate agents and mortgage brokers. There are loan brokers out there that specialize in the hard money space. But it starts word of mouth. And now we've built a marketing program, at least for the first fund, to reach out proactively to the folks in the industry. An entrepreneurial real estate agent sees deals all the time. We provide them with quick capital.
Okay. All right. My friend for 20 years, Keiretsu Forum, Silicon Valley member, Bing Heckman, who's with Colliers, so we have great expertise. It's an amazing market we have down here in the Valley, isn't it? Oof. Okay, the question, please.
Adam, since this is ordinary income, subject to ordinary income tax, can you hold these in an IRA account like a Pensco?
You bet. We have probably 18% of our Fund 1 in self-directed IRAs, and I would say about half of that is with Pensco. So I couldn't recommend them more.
Where is Pensco? If he's not in the room, are you looking at this? Travis is a sponsor of Keiretsu. Pensco He was over there. Okay, last question. Okay. Okay, Dennis Small, been a wonderful member of East Bay for the last 12 years. Retired Arthur Anderson Partners, 99. Great time to retire from there. Sits on 6 boards. How many boards from Keiretsu Form Companies? 1?
2.
Well, let's get you one today. Okay, so obviously you're asked to be on audit all the time because you're great background. Question, Dennis.
Adam, curiosity question. Fund 1, I guess, is about $100 million, you say?
660 AUM today, going to 100.
Okay. So you've got to turn that portfolio turns over on average every 9 months or so. What happens if economic conditions change where the demand for those loans goes down dramatically, either because rates skyrocket or whatever? Do you have, and you're sitting on $60 million and no place to invest it, what do you do?
Well, we would never be sitting on $60 million with no place to invest it. We would return the capital.
Is this a kind of shill question? You want them to probably put it in your investment bank?
No, just curious if what rights they have to return the money.
No, we have the ability to return the money at the end of every quarter, and we would. Frankly, we're not. It would just hurt the returns of the fund. Kind of a high-class problem to have. But the average term of the loans in our portfolio is about 9 months, so we could blow out of the fund pretty quickly.
Who does your legal work?
We were using Peterson Russell Kelly. We're now using Free Vector Advisors. We use several different law firms.
And you obviously need to use different ones.
Yes, we do.
Okay, because different state laws. Okay, time is up. Obviously, you have a booth. Thank you so much, Adam.
Thank you.
So.